Hello, and welcome to Cathmere Capital Management's third quarter 2018 quarterly market review webinar. I'm Nick Ryder, the Chief Investment Officer at Cathmere. Today's webinar is part of our quarterly market review series that reviews the performance of global capital markets, shares our insights into the drivers of performance, and provides our perspective and commentary on topical issues affecting long-term investors. We'll start off as usual here with just a high-level summary of the performance of global asset classes as of September 30th over the trailing 3 months, the year-to-date period, as well as the 1 year. You can see the trailing 3 months. They're presented in the green bars. The light gray bars represent the year-to-date period, and the darker gray diamonds representing the trailing 1 year. Working your way across the screen from left to right, you can see U.S. stocks far and away the best performer for the quarter. U.S. stocks up 7.1%. This represented or marked their best quarter in the last nearly 5 years, dating back to the fourth quarter of 13. Also represented the 11th gain in the past 12 quarters for the broad U.S. market. You can see further across the page then a very similar theme actually is that everything else handily behind the U.S. stock market. See non-U.S. stocks just incrementally positive for the quarter. U.S. and non-U.S. bonds essentially flat, and then incrementally negative returns there on global real estate and commodities, but then cash modestly positive returns. And this theme really kind of applies whether as you extend out your horizon, looking at the year-to-date basis, you see a pretty sizable gap there with U.S. stocks up 10.6%, non-U.S. stocks actually down nearly 3%. Bond markets, call it flat, and same thing there for the real asset indexes as well. And the 1 year story very similar again with U.S. stocks, strong positive returns in all other asset classes, right around zero for all intents and purposes, with some modestly positive, others incrementally negative for the year period. The next few slides will take a little bit deeper dive into the performance of the primary asset classes of stocks and bonds. So we'll start here with just U.S. stocks. You can see again the total market index all the way there to the left. And we're able to cut the performance into a couple of different dimensions here. First, looking at just how large cap stocks fared versus small cap stocks. You can see large cap outperforming by a couple of percentage points on the quarter. The year-to-date and 1 year trends more or less in line with that. You can see on the year-to-date, small caps actually outperformed by a touch, but over the 1 year period, large caps outperforming by a little bit more than 2 percentage points. Further to the right on the page, you can see the split between large cap value and large cap growth, and then all the way to the right, you see the split between small cap value and small cap growth. What you see present in both of those is a strong quarter for growth stocks relative to value stocks in both the large and small cap space. And that trend has been mirrored as well over the year-to-date and 1 year period, where those gaps become pretty significantly wide. With in the large cap space, for instance, you see large cap growth up 17%, large cap value up only roughly 4% in a similarly sized gap on the year-to-date basis. Long-term returns, as usual, plotted there on the bottom right-hand side of the screen. One thing that popped to me as we were preparing these reports for this quarter, just the absolute strength of the total market indexes over the long horizon there, with over the 10-year horizon now, dating back to the last few months, or the beginning few months of the financial crisis there in the fall of 2008. Even including those, the total market index annualized up 12% per year over the last 10 years. You can see the results even stronger when we look over the previous 5 and 3 years on an annualized basis. And I'll also just point out, again, the long-term gap that's developed between large cap growth and large cap value stocks. Pretty sizable gap, even if you look out over 5 and 10 years. Is something that we'll discuss in a little bit more detail in the slides to come. This slide here looks at similar unpacking of the returns in non-U.S. stocks. Total market index there up 0.8% for the quarter, down 2.7% on the year-to-date basis. You look further to the right, we split it into developed versus emerging markets. You can see developed markets outperformed the broader index, and emerging markets trailed. Emerging's had a pretty rough run of it in the last few months. It started out the first few weeks of January quite strongly positive, picking up where it left off in 2017, where presented some pretty solidly positive performance, outperforming U.S. markets, and since then it has turned downward. It's been a variety of factors driving it. So some idiosyncratic issues. Turkey has been under some fiscal pressures in recent months. Argentina separately suffering from some issues. China, which is a big part of emerging market indexes, has been hindered or hampered in recent months by the ongoing escalation between tariff and trade concerns. All in all, you've just now seen it accumulate to the point where emerging markets down 7.4% on the year to date and basically flat on the 1 year basis after a really strong 2017. Not as much to really discuss in terms of performance of large cap versus small cap or value versus growth international side. You can see the gaps between those two just not quite as noticeable or notable relative to what we saw on the slide covering U.S. stocks. And then lastly, just on the bottom right-hand side, one thing that does pop is, again, I'll call your attention to the total market performance. So while certainly positive in delivering positive absolute results over the last 3, 5, and 10 years, those are pretty noticeable differences between the absolute performance that we saw delivered from the U.S. stock market. This will be, again, something that we'll discuss or delve into in a little bit more detail in the slides to come. And here we'll conclude the asset class performance summary portion of the presentation before we get into the topical slides with just a coverage of the fixed income or bond markets. Not a ton going on in the bond markets. As you can see, the broad U.S. bond market index measured there by the Barclays Aggregate Index, when rounded to 1 decimal point, 0.0% returns on the quarter. The 1 year and year-to-date period slightly negative. Non-U.S. bonds slightly negative by 0.2 percentage points on the quarter, but slightly positive over the last year. And you can see pretty much across the board municipal bonds there as well, right around zero. You've seen short-term bonds modestly outperform longer-term bonds over all the periods shown there. That's just because short-term bonds have been less sensitive or less negatively impacted by rising interest rates. And then we can see as we continue to move further across the page to the right, credit risk or taking on additional credit risk in bonds has been rewarded over the last quarter, where you see Treasury bonds slightly negative, slightly riskier credit, more credit-sensitive credit bonds, slightly positive returns, and even more positive returns there from yet riskier credit bonds in terms of high-yield bonds. And that's a trend pretty much mirrored across the year-to-date and 1 year period, with your high-quality, safest fare of the Treasury bonds negative, but high-yield bonds positive returns. We'll flip now to what I describe as the topical or thematic session. And this is really where we provide our perspective and commentary on what we think are topical issues affecting long-term investors. And what this quarter's slides really focus on is elaborating a bit further on some of the points I've made earlier in the presentation, as well as which were covered in a recent commentary we wrote and distributed, which is titled "Why Your Portfolio is Probably Trailing the Quote-Unquote Market." And the impetus behind all this is really conversations we are having with investors of a variety of stripes. Some of them were clients of ours, some of them were clients of other firms, some were do-it-yourself investors. But what we heard in a number of these was investors remarking to us about the disconnect between what they would see on the daily or news coverage, talking about how stocks or the market was at all-time highs and had delivered really strongly positive results this year or over the last year, versus what many were seeing in their own individual portfolios, which were showing much more I'll call it lower returns, somewhere between flat to modestly positive on the year, but certainly not up to the extent of 10 or 20% the way you can see that U.S. stocks are on the year-to-date and 1 year period. And what we've often just pointed out to investors that we've talked to with is that see out there are well diversified and they're balanced investors, and what that means is that their portfolios generally comprise assets other than U.S. stocks. And in an environment where U.S. stocks were far and away the top performer of the major asset classes, um, any dollar that's been allocated away from U.S. stocks and into anything else, whether it be bonds or international stocks or value stocks, has just served as a drag on relative performance. Um, those are the three main culprits that we see here. We've seen in a lot of investor portfolios. We're calling them out on the slide here, and what we'll do in the slides to come is just provide a little bit more context around the relative underperformance of these main asset classes, as well as reaffirm or discuss the case for why investors may want to um, holding holding these assets in a diversified portfolio. We'll start here with we'll start first with bonds, and what we see plotted on the screen here is just the movement of interest rates over the last 5 years, with a real focus on the last, call it, year and a half now. And so we plot in purple there the effective federal funds rate, which is essentially the interest rate set by the Federal Reserve. So it's the rate that they control to transmit monetary policy into the economy. And what you've seen is that rate has steadily increased really since the late 2015, when the Fed hiked rate for the first of what has yet now come to be eight interest rate hikes to move interest rates off of the zero bound where they had been since the financial crisis. That rate now slightly above 2% after the Fed hiked rates for the 8th time there back in September. Closely mirroring that rate upward is they're plotted in blue, which is the 2-year Treasury rate. This is a rate that's highly responsive to monetary policy, just given its short duration. And then the green line plots the 10-year U.S. Treasury rate. And you can see that rate, only in recent months has it really started to follow the other two shorter-term rates higher as the economies continue to grow, as growth has continued to come in strong, and as inflation has ever so slightly modestly picked up. We plot these simply to show that rates have risen. We know that there's a negative or inverse relationship between interest rate moves and bond prices. So over the last year, really, where we've started to see these rate rises take hold, higher interest rates has put downward pressure on bond prices, and that's how we've ended up with flat to slightly negative returns. The bottom part of the slide, I'm not going to go through it in detail, but we wanted to throw it in here just to make the case that it's not any different today than it's been in past months or quarters. But we continue to contend it's where interest rates go from here is unknowable. It's unknowable to us, and we think it's unknowable to everybody else in the market. We think there are compelling, strong reasons for why long-term rates like the 10-year Treasury could continue to go higher. And we also think there are very compelling reasons as to why interest rates could hold steady or move lower. And we simply plot a handful of them that we've seen market commentators of various persuasions postulate, whether it be on TV or in research reports or in the popular press. We don't know where rates are going, and we don't think that anybody else out there possesses a crystal ball as to where they were, and we just wanted to plot some of the reasons why they could go higher as well as why they could go lower. What we do know, however, and this is, again, going back to the evidence, is that maybe perhaps a silver lining in these rate rises or the negative performance bond investors have endured, or flat performance they've endured over the last year, is that while rate rises are negative here and now in the short term and result in losses, they can ultimately prove to be positive in the long run, and this is because of the strong empirical relationship between a bond's or a bond index's current yield and its future returns. What we see here, what we plot on the chart, and this one's taken from J.P. Morgan, is along the horizontal or y-axis. plots the initial yield on the Bloomberg Barclays U.S. Aggregate Bond Index, which is an index we talked about earlier about the performance. Just measures the broad investment grade U.S. bond market. So we plot the starting yield on a quarterly basis, going back nearly 50 years for the index along the y-axis, or along the x-axis, and then follow the returns on that index over the subsequent 5 years, and we plot that based on the y-axis. And so what you see here is that upward sloping plot of periods where we've had low initial yields on the index have subsequently been followed by low and five returns over the subsequent 5 years. Periods where you had high starting yields were ultimately followed by higher returns over the next 5 years. And so, to the extent that rates have risen by nearly a percentage point over the last year, while investors have had some losses in the short term and here and now on their bond portfolio, their expectations for returns over the next 5 years are now consequently higher. And so you can see there, as of September 30th, 2018, the yield on the aggregate index, 3.5%. So that really does give us our best predictor of bond returns for the 5 to 10 years ahead. With that, though, and many have seen either flat performance or negative performance on their bond portfolio, or take this data here and see that bonds have relatively low versus long-term history nominal expected returns, and then they question why continue to hold bonds. And to us, it's always important just to point out and to remember the role bonds are expected to play in a portfolio, and that is to diversify equity risk. We do not think of bonds as the return-generating portion of a portfolio. We think that's better served by higher long-term returning securities like stocks, as well as a couple other asset classes. But we look really to bonds to provide ballast in a portfolio, to help manage or mitigate risk in the portfolio. What we see here, or what the chart on the slide presents here, is the average return of a slew of asset classes during periods of bottom decile returns for U.S. stocks. So the bottom 10% of months for U.S. stocks over the last nearly 30 years here. So think of it as the worst 36 months for the U.S. stock market. This then just plots the average return on a variety of asset classes during those same months. And what you see is, all the way to the left, all the asset classes that have delivered positive returns on average are high-quality investment-grade bonds. So demonstrating the role that bonds can play to provide diversification and ballast in a portfolio during otherwise troubling times for equity markets. And we think that that's important to remember, because while the last handful of years have certainly been good ones for stock investors, we know that stock markets are volatile. Even during the last 10 years, we've had a number of other drawdowns and periods of turbulence in there, and we think that bonds play a key role in a portfolio for many investors to diversify and to balance out some of that equity market risk. Ultimately, how much an individual investor's portfolio should have in bonds is going to be driven by each individual investor's unique circumstance. So their unique goals and objectives for the portfolio, their time horizon, spending needs, and personal willingness and ability to bear volatility and fluctuation. And so there is no right or wrong answer for how much bonds make sense in a client's portfolio, but we do think it's always important to recognize the role they can and should be viewed to play in a portfolio. We'll turn now to the second main topic of this quarter's webinar, which is covering the continued and extended outperformance of U.S. stocks relative to international stocks. This slide, many of you will recall from seeing last quarter. It's just been updated to add on another quarter's worth of data, but it shows the continued outperformance there of U.S. stocks versus international stocks since the bull market began in the early parts of 2009. One thing we're quick to point out to investors is that cycles of extended and significant outperformance for U.S. stocks, as well as cycles of outperformance for international stocks, are just part of the game. That the performance of U.S. and non-U.S. stocks has historically been cyclical. There have been periods of extended and significant outperformance for international stocks. Those are plotted there when the chart is blue and above the y-axis. The as well as we've seen periods of significant and extended outperformance for U.S. stocks versus international peers. That's when the chart is green and below the axis, and that's where we are today. Ultimately, our belief in the merits and value of international diversification remains strong. We've seen on previous slides that international stocks comprise a little bit more than 45% of the global stock market. So anybody that is limiting their investment set, opportunity set, just to U.S. markets would be excluding nearly half of the world stock market in terms of opportunities. But then also just pointing out that the role of diversification is really ultimately one about helping to manage or mitigate risk in a portfolio, and it's by positioning the portfolio to capture returns wherever they occur. We certainly know with hindsight being 2020 that over the last 9 years, an investor would have been far better served by keeping all of their portfolio in U.S. stocks. However, we didn't know that at the time 9 years ago, and that's ultimately why we diversify. Absent the possession of a crystal ball that's going to tell us exactly what's going to happen in the years ahead, we think the best thing investors can do is to make sure that they don't, quote unquote, put all their eggs in one basket by overly concentrating in any given market. And so we remain firm advocates of diversifying beyond U.S. borders. We've seen periods like this in the past where U.S. stocks have outperformed, and it's caused many to question the merits of international diversification. But we just like to point out that an investor, for instance, could have been sitting at the beginning of 2000 and looking back in time and seeing a very strong stretch for U.S. versus international and questioning it then. And it was ultimately followed by a pretty extended run of international performance. So the point to us is that we don't know what the next 9 years is going to hold. And it's because of that we think it makes sense that investors consider having some allocation to international stocks in their portfolio in the event that the strong returns do ultimately come from non-U.S. markets. One thing going for international markets as we think about the next 5-10 years and beyond is that as a result of their poor stretch of performance here in the current bull market, in a relative sense, relative to U.S. stocks, is that they're very attractively valued relative to U.S. stocks. This slide charts a version of the price to earnings ratio, PE ratio for the U.S. stock market, as well as that of the 5 largest developed markets, excluding the U.S., as well as the 5 large emerging markets. And you see the developed markets there plotted on the top part of the slide, and the emerging markets plotted on the lower part of the slide. The red line in both is the U.S. market, and the gray and black lines represent the various developed and emerging markets. And what you can see is that, and really called out in the data tables on the right-hand side of the screen, is that as of the end of July, the last data point we had access to, the U.S. was trading at an elevated valuation relative to foreign markets, or conversely, foreign markets were trading at a noticeable discount to U.S. markets. You can see on the developed front, ranging from the UK trading at about a 40% discount to the U.S. market, up to Japan, which is still even at a 10% discount to the U.S. market. On the emerging front, the gaps are even wider, with Korea and China there at nearly 50% discounts versus the U.S. valuation. Even the more, quote, relatively expensive ones of India and Taiwan, they're still at a 20 to 25% discount. We know that, and we've talked with many of you in different settings about the empirical relationship between starting valuations on various equity markets and their subsequent returns, where it's been demonstrated that low initial valuations have been associated with higher future returns on average over extended periods, whether it be a 5 or a 10-year measurement period, and that conversely high initial valuations have on average been associated with lower returns. And so to us, this suggests that perhaps over the next 5 to 10 years, if history has been any guide, and that the relationship between valuations continues to hold, international, developed, as well as emerging markets may stand to to deliver stronger performance than U.S. markets? We don't know. That's ultimately the case for diversification, and that's why we think it makes sense to continue to hold both U.S. as well as emerging markets, U.S. as well as developed and emerging markets. And the last theme we'll cover in this quarter's webinar is just the relative underperformance of value versus growth, which we talked about was reaching pretty significant magnitudes in the year-to-date and one-year period, as well as even the longer horizon. And we'll point out here on this slide is that value's underperformance in recent times stands in stark contrast to the long-term historical track record, which a large body of evidence shows that value stocks have outperformed growth stocks across time and markets. This slide just presents the evidence of value versus growth as far back as we have reliable data in U.S. markets, as well as developed non-U.S. markets, as well as emerging markets. And you can see over nearly 90 years there, values outperformed growth in the U.S. by about 3.5% a year. In 40 years of history, it's outperformed by about 5% in developed non-U.S. markets. And then in emerging markets, in the 30 years of history we have available, it's outperformed by about 3.5% as well. What this slide shows is that values outperformance is by no means an every year thing, and that nor is it guaranteed to show up year in and year out. In fact, like all other successful strategies, it comes and goes of periods of strong performance and experiences and periods of weak performance. What we plot here on the slide is on a calendar basis. At the top chart shows the performance of value stocks minus that of growth stocks in the U.S. market on a one-year basis. On the middle chart, we plot on a calendar year basis the performance over the preceding 5 years. And on the bottom chart, on a calendar year basis, the performance over the preceding 10 years. And what you see there, starting with the top one, is that on a one-year basis, value tends to work more often than it doesn't. About 62% of the calendar observations we have there over nearly a 90-year stretch, value outperform growth. So by no means an every year thing, marginally better than a coin flip. But when you extend the investment horizon out to 5 years, and so looking at it again on a calendar year basis over the trailing 5 years, you've seen value tends to be to work. Our value has outperformed growth more often than not. Now it's 76% of the time. So we've had 65 observations that were positive, 21 observations where growth outperformed. And then if you extend the horizon even further out to a 10-year basis, you've seen that values outperformed nearly 85% of the observations we have. Notably, you can see on the trailing 10-year basis in the most recent years, it's been negative. That has been historically unusual, but we've seen it before, is the point I'll also stress here, is that so while the 10-year period is negative now, and that puts it in the 15% camp of times where it has been negative, you've also seen stretches like this, most recently into the late 90s. You can see a few small gray bars there, as well as during the 30s as well. So while unusual in the sense that it's rare to see it, absolutely, but unprecedented values, absolutely not. We've seen stretches like this in the past, and value has tended to rebound. What I'll then point out here in this slide, exact same construct, but we'll look at the performance of another commonly recognized asset, which is stocks. And we can see, again, plotting the same way, performance of U.S. stocks minus that of cash, which is just proxied by 1 month U.S. Treasury bills. And we look on a one-year basis and calendar year returns, very similar results. In this case, we see stocks outperform cash 70% of the time. You contrast that with 62% on the time for value beating growth. But you start extending again out into longer investment horizons, and you can see on a 5-year basis, looking at these calendar year observations, stocks have worked 80% of the time, and that they've delivered greater annualized returns over cash over a 5-year horizon 68 times, and they've been negative 15 times, so 80% roughly. The value growth numbers there were value outperformed 76% of the time. And you extend out into a 10-year investment horizon with annual observations, and you've seen that stocks have outperformed cash 85% of the observations, 69 positive, 12 negative. The numbers for value versus growth, for those that recall, were 84% of the time positive, and that was 68 positive, 13 negative. The takeaway for us on this is just the understanding that all strategies go through periods of underperformance, even otherwise really successful strategies like that of investing in stocks, which have rewarded investors, disciplined investors throughout time. The other takeaway is that longer investment horizons increase an investor's chance of being successful. Right, when we go from 1-year observation stocks and value tending to work, call it 2/3 of the time. When you extend that all the way out to 10-year horizons, they start to have positive results in the 85% of the time range. So longer horizons do increase your chances of success. The flip side of that is nothing is guaranteed. There are periods, even as long as 10-year, where these otherwise successful strategies can underperform and have underperformed in the past. They're just price of admission. And then the last takeaway we look at is just, again, the similarities between value's empirical track record of success over various observation periods mirrors that in many respects of the strong empirical track record of stock market investing as a whole. And we'll conclude today's webinar with one more look at the performance of value versus growth stocks, this time focusing on a little bit more recent history, going back to the inception of the commercial Russell 1000 Value and Russell 1000 Growth Index. And what we plot on the slide here is the annualized return difference over the last 5 years of the Value Index minus the Growth Index. And so you can see all the way on the right-hand side through September of 2018, we've seen that value has underperformed growth by a little bit more than 5% per year over the last 5 years. And what we point out with the circled red areas is that we've seen periods like this in the past. You go all the way back on the left-hand side of the slide, and you can see in the 5-year period at the end of 1991, value had underperformed by about 5.5% a year annualized. You can look in the basically at the height of the tech bubble in late 90s into early 2000, you'd seen that gap was at some points as much as negative 12% per year over 5 years, where value had underperformed. And even in more recent times, you've seen that value's underperformed by nearly 6% per year annualized when we look at an observation as of March of 2012. So what we plot then on the slide is to see, all right, value's underperformed over a 5-year period, or here's how it's performed over the past 5 years. Let's take a look and see how value has done following these poor stretches. And so what we plot on this slide now in the blue line is how does value perform relative to growth over the next 3 years. And we've kept the circles on the slide to highlight these past periods of value, of notable value underperformance. And you can go back to the first one that occurred in the late 1980s into 1991, where value had underperformed by 5.5% a year for 5 years. Well, over the next 3 years, it rebounded quite strongly, and you can see the value index outperformed by nearly 6% per year over the subsequent 3 years. We saw a similar healthy rebound in value, and even of a greater magnitude, following the very, very poor stretch of performance in the late 90s during the tech bubble. Over the following 3 years, from the beginning of 2000 into 2003, you saw value outperformed, depending on the observation period, by as much as 20% per year over a 3-year stretch. The more recent example there, not quite nearly as strong in terms of magnitude of value outperformance. So we called out that circle that was looking back over the previous 5 years as of March of 2012, where value trailed by about 6% a year. The next 3 years, value outperformed by anywhere between 1% and 2% annualized. But then, as we've seen, that's or as we are well aware now, that that's reversed a little bit in recent years. But point here, of course, past performance is ultimately past performance. It's no guarantee of future results. What we wanted to do with this slide was simply highlight that even in recent times, even using commercially available indexes, we've seen stretches like this where value has underperformed. More often than not, we've seen value rebound over the years ahead. We don't think that, well, the recent underperformance of value is certainly disappointing. Obviously, we'd all love to see stronger performance relative to weaker performance. We don't think it invalidates the strong historical track record of value, nor does it invalidate the sensible and intuitive economic reasons for why value should or could be expected to outperform growth. And we continue to believe strongly in the prospects for value, and are excited to see what the months and years ahead may hold. So that concludes my prepared remarks for today. As always, if you have any questions or would like to discuss anything we've covered in additional detail, please don't hesitate to give us a call or send us an email. A few additional thank yous as always. So thank you for taking the time to listen in today, and thank you for the trust you place in us every day. We look forward to speaking with you again in the quarters ahead. And until next time, thank you.